Spot gold touched $4,697 earlier this week, the highest level since mid-May. But on Thursday, August 27, 2026, the metal has fallen back to around $4,577, giving up more than $100 from that peak. The weekly range tells the story: a high of $4,696.86 and a low of $4,494.44, with prices now sitting in the middle of that band. This is not a collapse in demand. It is a market pausing after an August surge of roughly 13 to 14%, with bullion-backed ETFs adding over 28 tons last week, the strongest inflow since January. The rally was real, but traders are now taking profits and waiting for clarity before Fed Chair Kevin Warsh speaks at Jackson Hole. The mood changed after Wednesday's PCE inflation report. The Fed's preferred inflation gauge rose 3.7% year-on-year in July, slightly above expectations and still far from the central bank's 2% target. Sticky inflation reduces the case for rapid rate cuts, because lower interest rates tend to weaken the dollar and make non-yielding gold more attractive. After the data, the US dollar recovered modestly, which added pressure on gold for international buyers. At the same time, initial jobless claims fell to 203,000, below forecasts of 208,000. The PCE figures followed a trend of resilient US data, and that consistency is forcing traders to rethink how quickly the Fed can ease. A tight labor market gives the Fed room to remain patient, and that patience is exactly what gold bulls do not want to hear. This is creating a two-way pull for traders. The CME FedWatch tool now shows a near 62% chance that the central bank keeps borrowing costs unchanged in September. That is a reality check for anyone expecting an immediate cut. TD Securities analysts noted that precious metals are comfortable in this higher range, but they warned the rally may be too early for a run back to record highs because energy prices and inflation risks remain. Vishal Chaturvedi from FX Street added that a firmer dollar and sticky US inflation are keeping the upside in check. For retail investors, the 28-ton ETF inflow shows institutional conviction, but short-term traders are trimming positions before a binary event. So the question for anyone holding gold is simple: has the rally already priced in too much easing, or is this just a healthy consolidation before the next leg higher? The next trigger is Jackson Hole. If Kevin Warsh signals that the Fed is in no hurry to cut, gold could retest the weekly low near $4,494. If he leaves a September move on the table, this pullback could reverse quickly. The wider debate is not just about one meeting. Some analysts argue a 25 basis point cut is already partly priced in, but the 2025 outlook, the Fed chart, and the tone for the first half of next year will matter more. With sticky PCE inflation, a tight labor market, and a firm dollar, the evidence currently favors the higher for longer camp. The key takeaway is this: gold's August rally was backed by real demand, but today's decline below $4,600 is a reminder that the Federal Reserve's words can outweigh the metal's momentum. If you trade gold, watch the dollar, the PCE trend, and Warsh's language at Jackson Hole, not just the spot price. The next move will come from the rate path, not from the chart alone.